Good morning, ladies and gentlemen. Well, the risk dial is deeply negative, and by my calculations, my manual calculations, we're about at minus 40. So things are not good, and things will continue to be not good while the bonds are probably in their last leg higher. And for obvious reasons, that is impacting equities and every other asset class. Let's have a look at what the yield curve is saying. Let's have a look at what the individual tenures are saying of the yield curve. And from that, we should be able to glean some information as to what other asset classes are likely to do in this, which is likely to be the last leg up in price of bond yields. I haven't shown you the 2s, 10s for a while, but I think now they have broken and are indicating the direction. Don't forget that these little wicks never happened. So this really 17.5 basis points was basically as low as it got on the retracement. Having closed at 9, I think every odd shows that we will retest this minus 10 level, and if we break it, we're going to go much lower, probably to somewhere around minus 44 basis points. This shows that the Fed is likely, or the market is likely, to force the Fed's hand to go a lot faster than it anticipated. And this should be the last leg before we get the steepening, and the steepening will be when we undo everything that's happened so far this year. But long way to go till that happens. First of all, the yield curve, I would argue, would have to go deeply negative. And here we have a weekly chart of the 530s, which to me is the most important indicator in the yield curve. I've put this line here in red so you can see it. We closed at about minus 5 basis points. This line is at about minus 10 basis points. But if we go back in time, you will see how important that red line is. And here we are. This is where, very close to where we are. Every time, and we are now going back in time all the way to 2000, okay? Every time it goes through it, it basically goes to 42 basis points negative, and then something like 55 basis points negative. That shows you how much space we have. Another 40-50 basis points of negativity in the yield curve in the 530s, which gives you an idea of how far 5s can go, and even with stability in the 30s. I think there is very little doubt that 530s now goes deeply negative. This is a weekly chart of the 5s, and I would argue that now there's no point in looking at anything but weekly or monthly charts to get levels. We have broken decisively, and people will say this is a first leg, second leg, third leg, and now we're in the fifth leg. Whether we're in a fifth leg or third or whatever, it really does not matter. This chart says that having broken the 308 level and this area between 299 and 308, we are in an impulsion higher. And if we go back in time to have a look at where those impulsions go, well, they always go to at least 359, and then you really get the panics up to 460. So 359 is my first target in 5s, and then you could really get a time when things get so bad that we go to 460. But there is no doubt to me that you have to be long of puts or short outright of the 5-year note. The belly of the curve is the one that will move most at certain stages, and now I would argue we're in one of those when the belly really moves higher and makes expectations of long-term rates significantly higher than we've had for the past decade plus. And here is the weekly chart of the 10s. The 10s have not broken out from the previous highs yet, but that's normal because the yield curve is pivoting. Now, whether it's going to pivot around the 2s or the 5s is neither here nor there. The 2s and the 5s are going to be more or less tied together. 324 is really my nightmare level. If we take out 324, we have basically taken out best part of a decade's worth of trading. And that indicates that the first stop is going to be 360. Another 40 basis points. And at these levels, every basis point matters. It really is, it means several things. It means, A, that credit spreads are going to balloon. It means also that the credit markets are going to close, more or less. So if we have a look at what happens, and bear in mind, look at this red line, and let's go back in time. Every time we've gone through it, we have gone to at least 360, and after 360 there is nothing really until this kind of level, which is 4%. Now, nobody would have said that 10s could go towards 4%, and that is why it's even likely to happen. I think through 324, 360 is almost a given, and then probably 4% is a given too. The all-important 30s, and those have not broken this very important cluster between 320 and 322, yet they're lagging, and that's why the yield curve is doing what it's doing. But I think the likelihood is that at some stage we break and we trade this level here, which is 345. 345 is going to be really, really important, and I think the 30s are unlikely to break it for quite some time. It would really surprise me if we broke it, because that would mean that the yield curve is parallel shifting, and that would mean, if you think about it, for 30s to trade 345 while 5s are still below 4%, that is unlikely, because that would basically means that the market is abandoning all hope that the Fed will be able to control inflation in the longer term, and I think that is unlikely, and also I don't see why that should be the case. So I think that this 345 level is likely to be the top in 30s. And that is the level that probably is going to signal some kind of a bottom in equities or in high beta equities. To me, the yield curve will go negative. The pressure will all be on the 2s and 5s. And really, if I see 30s here, I shall be buying calls on the futures rather than puts, looking for this to come back down together with the yield curve and every other asset as well. As far as Europe is concerned, basically abandon all hope, ye who enter. Unfortunately, it does not look like this is going to zigzag like I thought after the ECB. I think that, this 105, 107 area is almost a given over the course of the next couple of weeks. It just doesn't want to stop. I think I underestimated really how much pressure there would be from institutions to switch out of bonds. If we have a look at the bobble, the 5-year note, it's basically broken all levels, and it just shows you that in Germany it's the belly that leads, and in US it's probably closer to the 2-year note that leads. But really there's going to be very, very little support before this kind of area, which is around just over 150. So what can one say? The US and Europe are in coordination, higher rates in all developed bond markets. And here we have the Bund. I think, the Bund, the yield curve in Germany is now definitely flattening, which is a good thing, which shows you that really the pressure is on the shorter end and that the longer end can calm down. The longer end was leading, now it's definitely lagging. I would have thought this 170 area in the Bund is all she wrote for the time being, and then some sort of consolidation, and then we make our minds up again, according, whatever the events are. But I think in Bunds we are closer to the end of the run than to the beginning of the run. The French market has been the clearest chart since basically we started breaking these levels. I would have thought the top is going to be here around the 247 area, and that is going to be a very good risk-reward spot for a reaction back lower. And that would actually tie in with my thoughts about where the top is going to be in 5s and 10s in the US, and that basically the 30s in the US are unlikely to go through the area around 343, 344, just short of 350, before you get the move back down. So that is what I'm looking for. I'm looking for a continuation of the Bond Rout into and after the Fed, and then finally for this thing to, top out in the course of the next couple of weeks. This is a differential between the 10-year note and the Bund, and this actually has been one of my highest convictions that at some stage we would go down and retest this 158 to 153 area, and eventually we will break it, I think. The reasoning is very simple. Inflation is a global phenomenon, and things, I think, are actually worse in Europe than they are in the US, and therefore that differential probably needs to come in towards the 100 area. But, that's neither here nor there. What is important is that we could not sustain this 200 area, and we've come all the way down 40 basis points to this enormously important support, which hasn't been broken for years, around 153, at 153 to 158. That to me indicates that the pressure will not remain on the euro for very long, and that looking for much higher dollar price, DXY dollar exchange rate, is actually not all that likely. The odds are against it. At some stage we will bottom because of these differentials. And here is the Dixie. A couple of weeks of looking for stops and straight through. On a daily basis, I think we probably have consolidation until the Fed, some backing and filling, and then we probably go and we take out these highs by a little bit, but I wouldn't say by very much. If we have a look at the euro chart instead, to me, if we go to the weekly chart, you can see how important this area around 103.40 to 104.37 is going to be. Unless and until we get a break of that area, I really can't say that I can sell euros down there. To me, that's going to be very, very difficult to break, simply because the ECB is now matching the Fed, and I think they will, the interest rate increases are actually likely to become faster at the ECB than they are at the Fed. That's the way I look at it. But I could be easily wrong, and a break, a weekly close below 103.40 is going to be very bearish indeed. To me, the Dixie is likely, if it continues going up, it's going to continue going up because of the move in here in the yen. This is a weekly chart of the yen, and basically it's gone, hasn't it? I mean, I don't care that you've got this massive support at 135. If I look back in time and look how far I have to go back, I have to go back to 2000. Okay, so this is the 135 area, and I can put a reminder there, 135.13 or whatever, and you can see how many times it's traded up down to 135.13, and we are so close, and then finally it broke. Well, what is likeliest to happen? The likeliest thing is that we are going to be able to hold this 135.13 area for several weeks and then probably break it to the upside. Until it breaks to the upside, I think this idea that JGBs are going to be let go from the 25 basis points that the Bank of Japan is holding them, I think that is very fanciful, and I really, really think it's a bad trade to be short of JGBs because they always screw you. But I'm very, very aware of the possibility that basically we just break through 135.13 and keep on going. To me, it's far more likely that any weakness in or strength in the dollar comes through weakness in the yen rather than in the euro. Well, gold did something unexpected on Friday. It rallied in the teeth of a higher dollar and of higher bond yields, which is unusual. What does it mean? I think it means that there was some relative switching, probably out of equities and bonds. Some large player bought gold and got out of equities and bonds. Could even have been a central bank. What does it mean for the short term? Well, it stopped more or less where it should have done. It didn't make a higher high on the week. So really it's a marginal move, but it's a move against the trend or against what logic would have dictated gold should have done on Friday. So what can happen? Let's have a look on a daily basis. We got to the top of the Bollinger Bands. We are getting to the 50-day. I think we start closing above 1881. The likelihood is that we test this area around 1924 to 1929, this kind of level, and possibly all the way to this line, which is 1958. But I would have thought that if we start closing above 1881, we have certainly a $30-40 run into the 1925 area, and I think that is just pressure of buying rather than anything else. And I'll show you the chart of the spreads between the various asset classes now, and that will actually crystallize why I think gold might easily go and do this trade around 1930. Okay, so here we have my important spread between SPY and GLD. As you can see, really, we've done very little for the past. So this is the COVID crisis, when everybody sort of basically switched to safety, and then the run up or in equities when everybody basically did nothing with gold, and now people are getting fearful again. And could we go here to 202? Absolutely. That is a relative 10% move. So, a bit of pressure on equities and a bit of a bid in gold. But you can see every time we get down there, it comes towards the bottom of the move rather than the meat of the move. So that is definitely possible that people will buy gold and sell equities. And if we have a look at TLT against gold, well, we're back at levels that we were in 2011 when TLT was making a bottom, and that is also likely that we go and test that level. So as you can see, gold is being bought against both bonds and equities, and it's likely that as a result of that pressure, don't forget that gold is such a small market relative to equities and bonds, of course. It's likely that there is a little bit of more of a bid in gold, and that we go and test those 1920 something levels in the next couple of weeks as pressure develops on bonds and equities. The weekly DBC chart just won't give in, will it? It's broken the 2973 level. Are we likely to trade 3192, which is basically the highs? Yes, I guess we are. And that is all that can be said. While this chart does not turn around, don't forget that this is mostly gold. Mostly oil. There is very little hope for a turnaround in bonds, and therefore I think it's all coming together. This goes and tests up here, maybe breaks it a little bit. Bonds, especially at the short end in the States, reach the targets that I gave you around the 350 area, 360 in the belly of the curve, and then the pressure can come off in everything. That seems to me the most likely path over the course of the next several weeks. The GLD against DBC spread is not turning yet, okay? But I certainly think it's going to turn in this kind of area. And that is also another reason why gold cannot go too far to the downside, because it's just cheap relative to DBC. At some stage, this chart will turn. It might take a long time. It might take even a couple of years. But anyone who is too long of DBC relative to gold down here, I don't think over the next 2 or 3 years is going to make much money. He might make 10%, 5%, 15%, but he's not going to make the 40, 50, 60% that this chart told me I would make if I was long of DBC relative to gold from this level. And you will remember that I was talking here about, switch out of gold into DBC. And look, from 13, we've gone to 6. So that, that's 100% return. Here you're playing for 5%, 10%, 15%, whatever. But that is another reason why gold is unlikely to go too far down independently of DBC. So I would say now gold and DBC are going to be pretty well tied together, and at some stage gold is going to start outperforming DBC. Whether it takes a year or two, I have no idea, but I really wouldn't be short of gold versus DBC here. I really think the other way is going to be far more profitable over the years. Well, what are equities going to do? I have never seen a chart like this before. I have never seen expectations of E of the PE still go higher while the P gets murdered. As you can see that, I've gone all the way back into the 1990s and 1980s, and I've never seen anything like it. Expectations of overall earnings are still slowly rising, and they have risen since the beginning of the year. People are now talking, even when they've reduced certain components of the S&P 500, they've raised others, and they're still talking about $230 of earnings. So if you look at $230 of earnings times 16 even, that is 3,680. And that is basically 3,700 where this times 16 comes in. For the market to go substantially lower, you need to have the E start to turn over. I find it very difficult to believe that we will go through times 16 without a lot of trading sideways or gap filling. So this 3,700 area to me is going to be a bit of a bargain for the next couple of months. But the direction is also, to me, it's very likely that we have actually seen the top of the corrections that we are likely to see. So basically, and we will see that on a monthly chart, 4,200 is basically as high as it goes on the upside. And the downside is, well, who knows? For the time being, I would argue is around 3,700, but that also will change when this E rolls over and if it rolls over. And let's see how that fundamental chart of the Blue Angels matches with the SPX price chart. This is the monthly chart, and basically I said that these lines were going to be very difficult, these moving averages were going to be very difficult to break, and they're around 42 and a quarter. And that to me is going to be as high as any rally at any stage over the next several months can be. Let's call it here, or let's call it here. That looks like a good level. 4181, well, there you go, 4200, let's call it. Where is support going to be? Well, to me, the real big support on the monthly is going to be 3621, between 3500 and 3621. That is going to be the big support from where I would expect a 10% on the way up. So just have these levels in mind. To me, these are very important levels. Look what happened here. We reached 3621, then we never broke through it, and we are unlikely to break down and stay down below the monthly Bollinger Band. Well, the 195-minute chart did warn, and all these people now got absolutely trapped. That is the best part of over a week, 10 days of trading between 40.68 and 41.80. They got basically just stopped out and a continuation. Would I be surprised to see a test down here of 38.23? No, but at some stage you can see how we are still, we need to trade a bit sideways, and really we are likely to be still here before the Fed comes in. Quick dip down, get everybody bared up, and then probably back up towards this 39.50, 39.74 area. That is what is likely to happen for the next 3 days. And if we look at the daily chart, we love to see a little break below 38.55, below the Bollinger Bands, and then a quick run up again towards 39.80. Absolutely. I think that is more than likely to happen for the first 2 days of the week before the Fed, and then after that we will see. Still, the downside is my favorite side. I think the likelihood of us breaking this 42 area is very, very remote. These are risk spreads, and I find it very unlikely that the market is going to be able to just crash. This is SPY TLT, and really, as you can see, since, you know, what is this? We've been here since basically the beginning of the year. As you can see, SPY and TLT have really diverged very little from the price they were at the beginning of the year. That to me says that basically, well, I mean, it's obvious. If you look at the Blue Angels, 99.9% of all the move is because of the multiplier. We have traded down from the 20s down towards the 16s. And the E component has not changed at all. That means that all this move has been taken out by by TLT going basically lower and dragging SPY lower with it to an extent which is more or less identical to the move in TLT, right? It's slightly less. But it just shows you that TLT and SPY are still tied together. When will they untie? They will untie if and when we go into a recession. But the data is not there yet. And that is why I think that the equities are not going to go too far on the downside. As I showed you, TLT and the 30-year note, I don't think are going to break that much further. It's the yield curve that's going to take the pressure and the short end, and therefore equities are unlikely to move a million miles from this relationship that we've had for a while in SPY TLT. Even if you look at the Qs against TLT, well, where are we? We are more or less within 4 or 5 basis points that we were since the beginning of of what is this? This is March of 21. So even the Qs have not moved a million miles. So even high beta is really tied to TLT. Tell me what TLT was going to do, and I'll tell you what the Qs are going to do, and I'll tell you what SPY is going to do. So really, that unless and until this relationship breaks down, and we've got a very clear warning when it does, it's this level 234, you're not going to get very large movements away from this mean. Having a look at those spread charts, it's unsurprising that NDX looks much the same as bonds, doesn't it? Bonds, 30-year bonds have not broken the highs in yields, and NDX has not broken the lows in price. They are more or less at trading the same as I've just showed you in that Qs against TLT. So what to expect? Well, exactly what I think is going to happen in TLT and the 30-year note. It does a small break at the long end. All the pressure is taken by the 2s and 5s, and then we are in a position to rally again in bonds. And therefore, what is likely to happen? Well, we take out these lows by a little bit. We go and fill this gap down towards 11,276, and or possibly we go down to 11,000, and then we rally again. It's that kind of behavior. I don't think that we are anywhere close to a complete capitulation in equities, because I don't think that that is likely to happen in bonds. If the yield curve takes all the stress, and if the Fed does more quicker, the bonds are going to be satisfied with that, because that is going to be enough to tame inflation at some stage, where it takes 3 months, 6 months, 9 months, who cares? But that is likely to satisfy the longer end of the curve, and if the longer end of the curve is satisfied, this will stabilize the high beta sector, and then we can look for rallies of these levels. It's going to take time, but I really don't think that equities are the problem here. The problem are bonds. Bonds need to find the top in yield, and then you can look for a bottom in equities. And that is also why volatility, in my opinion, is not responding the way it should. Volatility is, if you ever look, this is a daily chart which I expand, it's basically bottoming around the 200-day moving average, which is going higher, but it's not making new highs. I mean, don't forget that these levels that we traded in January and February of this year have not even been approached. And where were we? We're at 4,700, so, and now we are what, nearly 1,000 points lower, and we are lower in volatility than we were at that point. What is that saying? That has to say that the more the market goes down, the less the market has to go down, because bond yields at some stage will top out. I think that volatility is still going to have a tough time breaking out into the 30s, and this is now a weekly chart, and to me this chart, this level around 30.11 is very key. If we start breaking out towards 34, I can then see us breaking the lows that we've had, but I think it's unlikely till after Fed, and it's unlikely until we have seen what the reaction is in the long end of bonds. I think the Nikkei actually encapsulates and shows what has been going on all year very well. This is a weekly chart on this side and a daily chart on this. People get bullish, smack back down. Even on a weekly chart, if we enlarge it, very little has been going on in the Nikkei because the yen has been taking nearly all of the pressure. This is 2021, okay? This is the level that we were at the beginning of 2021, and we are exactly at that level. So basically we've had a year and a half of going sideways. And I think that that is actually the correct analogy for how to explain it. The bonds in the bond yields in Japan have done nothing because the Bank of Japan has been holding it, right? The bond markets in the US had gone higher, and just like for the past year and a half, there's been no change in bond yields and no net change in equities in Japan. So the change in higher bond yields in the US has caused the change in equity pricing, just as I've been showing you in those spreads earlier. And that to me means that this relationship is not going to shift only when bond yields in Japan start going higher, and I don't think they will Nikkei come down. So if Nikkei is anchored, to me the likelihood is that the relationship between the SPX and the TLT is also pretty much anchored, and that means that whatever TLT does, SPY will mirror, unless we go into a recession. But we're a long way from data which shows recession. I've updated all the levels. I think all the pressure is going to be in the 2s and the 5s. You've got the levels, my position. 359 is my target, and I think we get it in the next 2 or 3 weeks. And I would really be surprised if the 30s go through 345. When 345 is achieved, I think, if it's achieved, I think that will be probably the bottom for the multiples part of the equities, and we can have some pretty strong bounce in equities. All the levels have been updated, and also I've here included the link to the 324% nightmare. So what do I think is going to happen in the tens? You get to that nightmare level, you stop people out, you take it 25 basis point higher, and then that is likely to be the last leg up of yields. Thank you very much indeed, and I will tweet you on Monday.